Well, the show's taking its sweet time. All right, I think we're up. Hello, everyone. Yeah, it's been some time since I made any kind of video because, well, I've been busy and I got lazy and yeah. So just kind of with all the things that's been happening in the market, though. I've been keeping abreast of it, on top of it. Uh, yeah, I got like some business on my own, so I haven't been trading like every day in front of a monitor. So I've been kind of like taking some other problems, other kind of business stuff. So um, but I just want to do a couple of quick things I want to talk about, and this time hopefully I do make it quick, given how long-winded I am and everything. So effectively, what some of the things that, as I've pointed out in on my Twitter, that when the market hit about like last week, late last week, around once it broke through down below the 3630, the 20 level or so, sorry, 3638 level or so, which took out the lows from June, right? But one of the funny thing about this move was that if you see the move itself, it's been like at that level for about a whole week, last week, and then it broke through. Now, the reason for my tweet was essentially to kind of think about two things can happen given the strength of the move down, and given that it's a bear market. Usually, when a bear market goes to a certain stage where starts to accelerate, what happens is that it can keep on moving down, and that move down can be quite violent, can be quite fast. Or the other portion is that this is at the pivot level, right? This is a pivot zone. At this pivot level, it's been hitting there for some time, and given that was the last low, you would expect that, right? Because there's essentially people at that level that it found a bid and the market found a bid and went up. So the same thing's happening over here. People found a bid and went up. Now it did go down below, and my tweet was about basically, hey, there's two things again. Like it could go down. The other option is that it could kind of stabilize here and kind of fight around this level. And those bids at that 36 low 36 level has to be taken out before the market goes down. Now I was expecting the market kind of to stay above, the go above 3,600 or so and kind of fight at that level. And there was some like a small rebound or something like that, right? To fight around this pivot because there's going to be people who are again coming in, bids are going to be coming in, and basically. There's going to be a lot of like bottom chasers who are coming in thinking this is going to be the bottom and what have you because that was the last low. Um, and also you have like people who are taking like taking their profits and closing out the shorts and all that kind of stuff is happening. Now, what's kind of interesting is that even though thought it was a rebound, the rebound is quite strong again. Now, this again shouldn't be surprising because this is what happens in a bear market. In a bear market moves like two times faster than a bull market, and when it bear market trends a lot more too. In a bull market, there's most of the time the trends are kind of like kind of mediated a little bit, right? It's not as strong, even though over a long period of time it has upward bias. But in a bear market, they're usually shorter and more violent. But one of the things you see in a bear market is that when it gets to accelerate like this, is that these rebound can be quite hard and they can like take your head off. And this is well normal, right? And so what happens though is that if you have a price level that's where prices tend to congregate, essentially what happens is that there's one side of the market has basically given up, in other words, right? Or one side of the market has come in and basically buy the market. Like let's say if there's this market kept on being at this level for 2, 3, 4, 5 weeks, that means it's putting a base for a upward move, right? And so essentially all the sellers get taken out and there's people coming in with strong bids. And so that means they're saying that I'm willing to buy and I'm going to be holding this market up, right? And by the time the sellers are done, market's ready to go up again. Well, that's kind of unusual in a bear market in this kind of a stage like stage two or stage where it starts to accelerate in a kind of like Stan Weinstein, that kind of a market technical stage type of a way of looking at the market, right? In this stage two, it's accelerating. And so this is shouldn't be surprising that when it rebounded that hard, even though, I'm going to be honest, personally, it's still surprising that how quickly. I mean, it's a matter of 2 days that it went up like 4 or 5% or whatever. Yeah, it's well above that, I think. So, but anyway, so what does it mean? That means that essentially it hasn't really put a base, right? Because that means that there's still a lot of people who are buyers are coming in, and but they're not able to, like, there's a lot of range. They're not able to stabilize the market, and so to speak, essentially, what happens is that the sellers, in a move like this, the buyers that are coming in are going to be basically future sellers, essentially, right? Um, because if you have a level, like if you have a strong base, right? What happens is that all the sellers are kind of like you're taking them out, right? In the situation, right? They're sellers, but the sellers for now has petered out, right? All the sellers over here, they're not really out, okay? Because then essentially all the buyers will come in and hang over here and take all the basically ask over here, right? And basically all the sellers over a long period of time. Well, that hasn't happened because all the sellers are still in their position. And so what ends up happening is now, the bias is that, again, this is, my going bias is that essentially this is just a regular bear market move. It is going to be more violent as we go into more of this cycle, this stage of the bear market, and especially once it comes down, it's going to retest, this level, the 36, 30, whatever, 38. It has broken through already, so now it's going to retest this whole level now, right? And if it does break below 36, let's just say 36, what is 13 or so, um, I would expect again the market to kind of start going down, and this time again it's going to likely accelerate to the downside. Now, in other words, maybe we see capitulation. Um, Maybe, I don't know. But anyway, so there's still quite a bit of downside way to go. That's the basic gist of it. Uh, so I don't want to, like, again, brag too much about what I got and what I didn't get. This year I got almost like all of the things right. Um, Knock on wood. But yeah, just to give an update, the because looks like the market, yeah, even though the bias is to the downside, it did a rebound and it rebounded quite hard. People, it's common, and the market has to prove itself that the previous mode of market action has been, kind of is not legitimate anymore, right? It kind of um, the market has to reject that essentially for us, and then go into new directional, direction, right? For us to have like a new bias. So till that new bias forms, we're really in the same kind of environment as we were before, which is a bear market. The market has to now keep on making newer higher lows and newer higher highs. It has to do a lot of work for this to. It has to basically repair market action quite a bit for this to be to be a bull market again anytime soon. So that's basically what I wanted to kind of show price action wise. Um, I probably, like this time again, I'd probably do like a bigger video on the weekends or whatnot. I'll say that, but man, I got like weekends, either fun things happen or like, um, or other important things happen. So like anyway, so that's basically what I would kind of little short quick update. The other thing is also the thing with what was the name? Credit Suisse. I think that's obviously what happened with Bank of England and all that. I'll probably talk about it later or whatever because that's a little bit more complicated, or it's more not complicated. It's more has it has an effect on everything, right? But um, it's really in the direct sense really related to what's happening over there in England. Now, what I wanted to kind of talk about was Credit Suisse because I think this might be important for Americans, that is, or the American equity market, and that is because so Credit Suisse essentially is it's a major bank, right? I mean it's not like as big as people think it is, but it is definitely one of the major banks in the world. I mean it's Credit Suisse, right? Um, and so what happened is essentially the Credit Suisse Swiss is basically hemorrhaging cash. They have not run well, and there's a chance that they might go bankrupt. Right? This might be and they have quite a bit of risk on their holdings and the portfolios, and so this might end up being they might go under. Okay, so that's basically the problem. Now that's the problem, and the thing is that I'm more aware of like what's happening with Deutsche Bank because I've traded Deutsche Bank before. However, Credit Suisse wasn't something that was my, like I know there's quite a bit of backstory, and I never really cared about it, but and that's really kind of like on the side. I mean, it's not necessarily directly related to what I'm going to be talking about, but that's something important to understand what's happening in the background. But what in 2008, what happened in a similar situation was Lehman Brothers and Bear Stearns and Lehman Brothers, right? And what happened is that essentially they kind of let Lehman Brothers to capitulate, and off you go. Now, the result of that is kind of this cascading effect that uh, caused us with the financial crisis in 2000, that time frame. Um, Now, what the governments have, since then, what they have done is that all the sovereigns is that they backstop their banks, they backstop everyone. In other words, that they're essentially saying that I'm not gonna let you gonna fail because this might cause a systemic like again a cascading second order effects where it takes out who knows what people out of jobs. This might have like a wrecking ball effect on everyone. So now, imagine that, but in Europe, right? And this has implication because uh, Credit Suisse uh, has their pie in a lot of places, and a lot of people have their investments in, Switzerland, especially, and Credit Suisse being one of those, one of those important banks. Now, the what that implies is that essentially the governments, they, instead of letting things fail, they have started to basically backstop as the U.S. have done back in 2008. This is the lesson, and to kick the can down the road, so to speak, right? In other words, that we'll have a problem, next problem with a bigger problem, but we're just gonna backstop and we're gonna cover them, bail them out. Okay, too big to fail, whatever, stuff like that. At some point this is not going to work, but till the day happen that comes around, well, we'll just keep on doing this. And that's, I think, what's going to be happening with the Credit Suisse, because with the war in Ukraine, with energy costs, with post COVID, with the problem in America, with social problems, with migrants. I mean, it's like like it's just like problems after problems, right? Um, Problems with China, zero COVID policy, uh, deteriorating relationship between Europe and China, all this other kind of stuff. Like you add them up, This is not like just 2008, like where like there's just um, you know um, like one axis of like things to do, one one a few few um, dynamic to deal with. This is we got like 10,000 different things happening nowadays. So, in other words, what I'm saying is that they're not likely to let Credit Suisse go because if they do, then holy crap, a lot of things are gonna go down. So what they will do is they'll bail him out, likely. Again, it's probability. Probability, in my opinion, is pretty high that they're gonna bail him out. So if they bail him out, what happens is that who's gonna bail them out? Well, it's gonna be the Bank of Central Bank of Switzerland. Well, one of the funny things is that one of the biggest investor in the U.S. equity market, especially the FANG stocks, Apples and people like them, is Swiss Bank. I mean, that's basically they're kind of like their Fed, right? And so what happens then is that if they have to bail out and to make Credit Suisse good, they'd have to close down some of the positions in the positions in like Apple and you know Meta, Facebook. I mean, sorry, Meta, right? I always make that mistake. Force of habit, stuff like that. Twitter, well, the Twitter now is going to be, going private. But my point being that essentially, Apple is like I think Credit Suisse is like the biggest investor in Apple, I believe. The point being that this will have again a and this is like it's accelerationism on crack now, right? Because what happens is that one of the legs of this bear market or recession, it's really recession, in my opinion, that is recession with having jobs, I guess, um, is that Apple forms like the core of like almost all funds, people's portfolios, people's in their like 401ks, and so essentially like something like 7-8% or so of S&P is in Apple. So what that implies is that look at Apple. I mean, they've done pretty well, right? They've outperformed SPX. Um, right? So in June they went down to 129 and they're at like 140. So um, relative performance wise, relative strength wise, Apple has shown more strength. And partially the reason is because they have acted as essentially a safe haven, okay? Because of there's just the nature of the company because it's everywhere, um, and um, and so and it's a big company, as name and all that. I mean, it's Apple. Um, So what happens though is that this is the one leg. In other words, what I'm saying is that essentially rich people in this position, big positions are in it. Okay, institutionals are in it. Okay. So if you have, let's say, all the small companies and essentially like 10%, like the top 10 companies are holding up this S&P, right? Most companies are like in deep bear market. Okay. Although Rudd is doing a little bit better. Um, so so basically in S&P 500, like if most of the companies are down, so basically if most of the companies are down, what's holding up on the opposite side from S&P 500 from going down too fast or too much is people going into Apple. And the people who are still going into Apple and holding on positions, remember, because they haven't really sold out as much as S&P 500, is these big like portfolios. And so this is the danger is that the next leg, in other words, in this bear market, any kind of bear market you have a flush out. And that flush out happens when essentially everyone sells out. The people who sell out, the last ones to go are the companies that were holding up the market. And usually they're going to be like the blue chip types or the big name types, aka Apple. And so what you're seeing is that those people haven't really sold out yet. I mean, yeah, they have gone down in price. Obviously, there's selling pressure, but relative to the stock market or relative to many of these other companies, right? Um, they haven't done that bad, and they haven't taken out the low of June. So what happens is that this is a this is a concern that I don't think many people are thinking about. Is that if Credit Suisse or the Bank of the Central Bank of Switzerland, they started to if they start to close down their positions in some of these U.S. equities, aka stuff like Apple, then this will put a downward pressure on the central portfolios of essentially like the all the big funds, right? And essential of the people with the big money, right? The big boys, the big capital. I'm speaking of people with like $1 million 401ks and people like them. I'm not speaking of like a guy with a $50,000 account or $100,000 401k in like diversified whatever, right? Some random fund. So essentially, when you start to see Apple get sold and this big amount of capital to start getting flushed out of the market, then we will see another leg of the market going down, and that's going to be kind of like that's going to be even a more stronger downside move. But that move will be kind of like the last portion, the kind of the last leg. That's like the more true. I don't know how to say that. Like like that's when the bear market's kind of like has it's like at its at its most like uh, violent, strong, level, or at its like most bearish, I guess. And so what's going to happen is when people are done selling Apple, that's basically the time it'll be for the market to kind of find a bottom, because at that point basically all the buyers or all the people who were holding on are gone, because all the small caps are gone, right? All they have like deflated in value, and their PE ratio, their all the ratios will be lot more attractive, and so will be the same for Apple, right? But for that to happen, though, a lot of people have to sell out, and the concern here is that if Central Bank of Switzerland start doing that, then we might have a rush to where this will put a downward pressure to where this will cause all these funds to start selling their own holdings, which will have like a you know kind of a this will like strengthen the downside potential even more, and have this like exponential effect on it, right? This quite that's going to be a big move. So if Apple goes, S&P 500 will go, and that's when there'll be doom and gloom even more so than now, and that's when we should see like maximum doom and gloom, right? When Apple starts to go down, because again, it's the big boys are going, losing their shirt, so to speak. And so yeah, and when Apple finds a bottom, everyone's crying. Everyone's like, there's people like who are committing suicide. On unfortunately, I'm not. I'm really serious about that, but not joking. If the stuff like that happens when people are they say, "Hey, I'm done," and I've listen, I've been in professional scenarios, so I've talked to people who were in that boat. People who had like $3 million in the dot com bubble, right? And then overnight they had like $100,000 or so. Um, when stuff like that, when that you start hearing that, that's basically when we are approaching the end of a bear market. But I just want to say that because that's cause for concern. That might be, that's not might be that's a like a systemic a like a structural problem here, because these the if all these big all these big banks have to cover their the short calls, right? You know, they gotta cover the shorts. So what happens? They gotta sell out. If this starts selling at U.S. equity, might be bad time, and that might like act as a catalyst for something worse and then start to um, kind of accelerate the market as it goes down. So I don't want to keep on just babbling here because I think I've run out of ideas. I didn't get that much sleep, so I should just stop it here. It's been 25 minutes. So cool. I talk to you guys later, and hopefully I get to do a few more videos, go more in depth about like I did when I started doing my videos early on. I just want to do this to a few quick updates here because yeah, uh, basically TLDR markets bear market kind of a stage two bear market pattern. You'll see bigger ranges in everyday moves as the market starts to get away. So this is perfectly, as one would expect, one should expect. And so, but this is still, big. It's a strong move that even caught me kind of like it exceeded my expectations for how quickly it moved up. But again, this is par for the course. And B, Credit Suisse, if it goes down, the implication of that is that they're probably going to be bailed out. The implication of that would be uh, S&B or the Central Bank of Switzerland um, has to basically cover some of the positions like and in U.S. equities, and that's the case, that might cause um, significant decline in Apple because those are institutionals, bigger institutionals getting in the act. This is gonna. It's not like me and my buddy with the 100,000 or whatever. I don't know, a million. Like moving the market. We're talking about like, I mean, hundreds of billions, trillions. Who knows, right? Um, there's also counterparty risk that each of the counterparty has to like cover their positions. So that's why might be cascading effect here. So anyway, so yeah, I'll let this go. It's been 27 minutes now, so I don't want to keep on again talking the same thing. So see you guys later, and yeah, have fun.